pixel hearts are beating for you. I'm lost in this electric haze. Just
somewhere between pressure, strategy, and opportunity, there's always a move. I'm Nathan Scott, and this is What's the Move. Let's get started today. Today's scenario is my cousin wants to make money instead. Well, my cousin wants his money making money instead of chasing forever. All right, this is one of the most important important transitions in personal finance. Moving from being the engine to owning the engine. I'll break this open, and I'll break this open completely. Now, as you can see, what this scenario appears to be is a person likely self-employed or in sales or running a business who is tired of trading the time directly for dollars. They want passive income, investments, or something that generates money without their constant active involvement. On the surface, it looks like a simple "how do I invest?" question. But what it really is this is a transition from labor-based income to a capital-based income. It's not just about finding an investment. It's about shifting identity from the person who sells to the person who owns. That's what it's all about. That's what it's all about. The cousin has likely spent years being the engine, making the calls, closing the deal, and generating the revenue through direct effort. Now, that's an extraordinary skill, let's be honest, but it has a ceiling. And the ceiling is the number of hours in a day, which is a ceiling. And the real question is, how do I convert the proceeds of my labor into assets that generate income independently of my time? So the deeper layer is, this isn't just about stock. No. No. So, it's not just about that. And it's not just about, like I said, it's not just about the stock, sorry about that, or the real estate. It's about understanding It's about understanding the spectrum of assets that could produce income and maintain them to the cousin's starting point, or how much capital they have, how much time they want to spend managing assets, and what their risk tolerance is. So, all right, so let's move forward. Now, like before, what is the hidden opportunity? Well, most people, they want money to make money. Let me say it again. Most people who want money to make money make two mistakes. The two mistakes they make is, first, they chase high risk speculative investments such as crypto, meme stock, day trading, because they want fast results. Understandable. The second is they underestimate the power of boring, cash flowing assets. And that compound quietly over years. Now, the hidden opportunity for someone coming from a sales background is actually an advantage. They understand cash flow, they understand customer acquisition, and they understand business models. These skills translate directly to evaluating income producing assets. Now, a salesperson can look at a business, a rental property, or an income fund and understand the revenue mechanics better than most pure investors. And that's large. Okay, there you go. So the real opportunity, I want everyone to know. This is in income producing assets that leverage the cousin's existing business acumen. So bear with me, please. Let me go over that one more time. I want to make sure everyone gets me clear, because I did go over that a little fast, maybe too slow. But anyway, this is what I want to make this point very clear. They understand cash flow, right? I had to make this because they do. And they understand customer acquisition. These are salespeople. And they also understand business models. Now, these skills, as I mentioned before, they translate directly to evaluate income producing assets A salesperson can look at a business model or a business, a rental property, or an income fund and understand the revenue mechanics better than most pure investors. And that's large for them. And the real opportunity is in income producing assets that leverage the cousin's existing business acumen while gradually freeing their time. So we will go over now the asset spectrum, from fully active to fully passive. Let's map the landscape of money making money from most active. This is from most active to most passive. Now, asset type effort require typical yield capital needed time to income and owning a business operating very high 15 to 50% varies. Ongoing real estate direct ownership, medium high is 8 to 15%, cash on cash, and about 100K plus to like 1 to 3 months per property. Private lenders / notes, low medium, and that's like 8% to 12%, and that's about 50K plus to 50K plus 30 to 90 days. Dividend stocks, very low, and that's like 2%, 2 to 5%. That's about 1,000 plus quarterly. REITs are real estate investment trusts, particularly, and they're very low at 4 to 8%, and that's like $100 plus monthly / quarterly. Now, also you have high yield bonds. High yield bonds are or bonds fund very low at 5 to 9%, about 1,000 plus monthly. Then you have private equity. Syndications very low. After due diligence, about 12 to 20%. Plus 250K plus, about 250K plus, and that's in 1 to 5 years. Royalties, that's music, patents, minerals, very low. That's 5 to 20%, 20%, and that's like 100K plus. That varies, and that varies as well. Also, you have digital products. Like online assets. That's online assets are low to medium after building 20 to 50% plus. So that's like about 5K to start, and that's like 30 to 90 days. Now you also have peer-to-peer lending, very low. That's like 5 to 10%, $100 plus monthly. So what are the best practical paths? What are the best practical paths? The best practical paths for someone what are the best possible paths for someone transitioning from active sales? All right, let's go over, before we go there, because I have been going over the paths a lot. I don't know if people are knowing this is when you need to take notes, but this is when you need to take notes. Because this is a part of the solution. So when you see me going over the path, know that this is not the time to kind of just watch like it's just entertainment. I'm giving you solutions. And once I go over the paths, I'm going to show you how to do the paths. Okay, so this is important. So what are the best practical paths for someone transitioning from active sales? Now, we have several paths, but we're going to go over them. I might have, whatever. Right. So, as you can see, there are about 5 different paths that a person can choose. Of these paths, one of them can get you there, or all of them can get you there, or a combination of 2 or 3. But nonetheless, they are the solution. They are aiding in the solution, at least, where we are getting to what this show is really about. So let's go over them. Path A, the dividend path. A dividend growth investment. Now, dividend growth investments are lowest effort but are the slowest to start. What is it? Well, you're buying shares of profitable companies that pay a regular dividends to shareholders. Now, these companies generate profits, return a portion to owners, and typically increase those payments over time. Why it fits a former salesperson is a good question that we want to answer, and that is because it is the closest thing to making money with almost no ongoing effort. You buy ownership in businesses, and those businesses send you checks every quarter. They're sending you checks every quarter. Now, realistic yield. The realistic yield is 2 to 5% current yield with dividend growth of 5 to 10% annually from quality companies, which is good. Now, what to buy? You want to go over what to buy, and that's important as well. What should you buy? Well, let's see. Dividend aristocrats, this is what they usually buy. They buy companies that have increased dividends for 25 plus consecutive years. For example, Johnson & Johnson, Procter & Gamble, Coca-Cola, McDonald's. Another thing they buy are dividend ETFs. For example, you got SCHD, that's Schwab US dividends. And that's Schwab US dividends and equities, EFTs. Also, you have, which has about a 3.4% yield. Now, also you have VYM, which is Vanguard High Dividend Yields, ETFs, and that's at a 3% yield. Then you have DGRO, which is iShare Core Dividend Growth ETFs. Those are real good. These are good dividends. These are good ETFs to buy. Then you got cover call ETFs for higher income, and that's also that would include JEPI, that would be JP Morgan Equity, and premium income ETF, which is a premium ETF. A premium income ETF, and that yields at about 7 to 9%. Also, you have JEPQ, which is the NASDAQ version. Then you have DIVO. For example, you got $1,000 or $100,000 invested in a mix of dividend ETF yielding. at 3 to 7% generates about $7,000 per year in cash deposited directly into your broker's account, with no effort required after the initial purchase. Now, as dividends grow, more capital is added. The income stream compounds. Tax efficiency notes that qualified dividends are taxed at lower rates, like 0 to 20%, than ordinary income, making this more tax efficient than earned income. All right. Hope you got that. So that was Path A. Path A, the dividend growth investing. That's what we call boring money that compounds. People like boring money? I do. I really like it. I'm not gonna lie to you. I really like it. It's not boring to me, just to be honest with you. Not at all. So right there, we know that we already got a Path A, and you're not bound by any rule. You can start investing in those dividends ETFs today. Well, not today. Well, yeah, if you're out west today, if you're watching this show and you're out west today, you have a chance to do it today. If you're, no, it's Eastern Standard. Sorry, I don't know what I'm talking about. Duh, the market's over. Markets ran about Eastern Standard Time. Sorry, tomorrow, 10 o'clock. Or you can just make an investment, and then tomorrow to go through. Well, invest in one of those. Put some money up. You got companies that allow you to do that. Okay, we're not going to stay too long on that. We're going to go to our next one. And our next one is Path B. Path B. Now, Path B is the Real Estate Investment Trust. And these are REITs. REITs. Now, real estate without tenants is what I'm talking about. What is it? Publicly traded companies that own and operate income-producing real estate. By law, REITs must distribute at least 90% of taxable income to shareholders as dividend. Why is this? You get the income benefits of real estate without being a landlord. No tenant, no toilet, no 3 a.m. phone calls, just quarterly dividend checks. Good deal. Types of REITs. Types of them are residential REITs. Avalon Bay. Check out Avalon Bay. AVB. AVB. Equity Residential. EQR. And these are apartment buildings. Commercial REITs. And they include Realty Income. That's 0. That's O. You look at it on the stock there under O. The monthly dividend company, and that's the monthly dividend company, 5 to 6% yield are healthcare excuse me. All right. Yeah. Reality income. So, realty income. That's the reality. But realty income. Now, what about, now we're going to go over some more types of REITs. And that one is healthcare. Healthcare REITs will include Welltower. Look them up. Welltower would be WELL in the market. Senior, they are responsible for senior housing and medical offices. Then you have data center REITs. A lot of people don't know about the data centers. They're coming about. These are some good investments for people in the future. Get your family situated. Get everybody set up. New companies on the horizon. They're going to be needed. They're creating bottlenecks as we speak. Get yourself in the door. You can create some generational wealth. If you got a significant amount of money, I will look into investing in some data center REITs. And they will include Equifax. What? Nope, I did say Equifax. Duh. No, Equinix. And they is EQIX. Also, you have Digital Realty, DLR. Then DLR is the infrastructure of the internet. Now, industrial REITs. This is what a lot of people are not going to tell you about these. Everybody's going to tell you a bunch of stuff. They're going to give you a bunch of information, a bunch of hype, a bunch of let's do it, you can do it, read the stuff on the mirror, build a vision board. Yeah, nothing wrong with that, by the way. I think it's nice. It's not enough, guys. It's not enough. Industrial REITs. That's Prolongis. That's PLD on the index. Also, and Prolongis is or Prologis. Yeah. What was my spelling that? My pronunciation. It's all good. It's everything. It's everything. Surprised I can get this stuff to you guys. And they would include warehouses, logistics centers. Now, you also have mortgage REITs. Mortgage REITs would be AGNG. You also have investment, AGNT investments. AGNC. And they have higher yields, which is at 12 to 15%, but higher risk. Also remember, everyone knows that. The higher the yield, the higher the risk. Okay. Now, here are some examples. For example, if you take $50,000 in realty income, that's the O and the index, at a 5% yield generates about $2,750 per year in monthly dividends. Checks. That's checks. Monthly dividend checks. 50,000 in diversified REIT ETFs like VNQ generates roughly $2,500 per year with broader diversification. All right. Hope you guys taking this down. Make sure I give you plenty to work with. That's my goal. Okay. The next one is Path C. Path C. But let me take my time for a second. Anyone that has worked in sales knows what this person cousin is doing. Anyone that's made a significant amount of money doing something that takes time to do knows what they're going through. And this is what I mean. I have a friend. That's why this is because, and I'm gonna let him know about it because he was in sales for. I'm not gonna say that. I could maybe, but anyway, he was in sales for. Well, he was in sales. I'm so debating and tell because it kind of made me mad when he told me. But he was the top seller. He wasn't just the seller. He was the number one guy. He sold the most products in the shortest period of time and did it consistently the most. He would consistently be top seller every month after month. One day we had a conversation, and in this conversation we were going over, he was frustrated, and he was frustrated. His frustration was, he's making about, I would say, if I'm not mistaken, about $8,000 to maybe 20, depending. It would fluctuate throughout the month. So I was like, okay, that's not bad, right? You know, I said, well, how much are you bringing in for the company if they're paying you that? And he says, I'm bringing in about $500,000 a month for the company. And I said, that makes no sense. And that was his frustration. I'm making all this money for them, but they're only paying me this. Now, another person might say, well, $8,000 to $10,000 a month is pretty good money. Depends on how hard you work and how good you are. I believe a person should be bringing about $8,000 a month. I mean, that's a lot of money. Because let's just say if I give you 10% of that, that'll be $50,000, right? And if I give you 1% of that, that'll be $5,000. But let's put it together. If you make it 10%, then that's about $2,000. If you make it $10,000, that's about 2% on a $500,000 sale. That's crazy. I'm telling you, that's crazy. So, you want to have, if you are in sales, and this is happening, you need your money working for you. More desperately than the rest. Okay? Now, let's go over it. So, let's go to Path C. Path C. Path C. Path C is the private real estate lending. Now, this has a higher yield and has moderate involvement. What it is acting as the bank. You lend money to real estate investors who need short-term capital for flips, renovation, or bridge financing. They pay you interest, typically 8 to 12%, secured by the property. Why it fits a salesperson, you may ask. Well, this requires some relationship building and deal evaluation skills a salesperson already has. You're not fixing toilets. You're not evaluating you're not fixing toilets, but you are evaluating borrowers and deals. Now, how does this work? What you want to do first is find a real estate investor who needs capital. Local real estate meetups is one place you can meet them. Another place you can meet them are at Bigger Pocket. You in here, buddy? Oh, I forgot to introduce my buddy. You just sit here. Hey there. Hey. All right. I'm getting loud, so man, you guys shut it down. Okay. But you got your local real estate meetups. Also, you have your bigger pockets. If you look it up, bigger pockets, one word. And you have private lenders or lending platforms. Now, 2, lend them money secured by a mortgage or a deed of trust on the property. That's what you want to do. Let me say that again. You want to lend them money secured by a mortgage or a deed of trust on the property. They make monthly interest payments, and at the end of the term, which would be about 6 to 24 months typically, they repay the principal. The good thing is you can have platforms that handle the details. For example, you got platforms like Ground Floor. And Ground Floor like Ground Floor. Good. But Ground Floor is fractional real estate debt as low as about $10 per loan. And that's like 8 to 12% return. Also, you have Fundrise. Fundrise is a real estate private credit fund. And that's 7 to 10% target yield. Another example is another company is Peer Street. Peer Street, when operational, is a real estate debt marketplace. Then you got direct local lending. Now, direct local lending is higher returns, like 10 to 13%, but requires finding a vetted borrower. Now, here's the example. You got $50,000 lent across 5 to 10 different real estate loans at an average of 10% yield, generates $5,000 per year in interest income. The loans are typically short-term. They last for about 6 to 18 months. So capital recycle quickly. Here's the risk though. I want you to be very aware of the risk. The risk is that borrowers default, property value declines, and illiquidity during the loan term. Not long term, during the loan term. Now, also mitigation by lending at conservative loan to value ratio, 65 to 75% LTV. All right. Hope you guys been taking notes. Don't waste me time. Don't waste me time. Okay. Now we're on the path D. Path D. Everything looking smooth. Everything's seeming cool. We are on to path D. Path D is acquiring existing cash flow. Now, let me go to that for you guys. Path D is acquiring existing cash flow businesses. And the good thing about, and this is the salesperson's superpower. I'm telling you, I don't know why a lot of salespeople ain't into this, but hey, hopefully a lot of you guys will get into it by then. It's trying to change the game, guys. Seriously. I'm gonna tell you why I'm doing this, guys, so people now know. Let me go to the main show. I want you guys to see that. I'm about to eat a piece of ginger candy. Sorry, I'm allowed. But anyway, I want to tell you why I do this. And this is for real. This is for real. Guys, our world that you guys live in are full of haters. They are. They're full of haters. And they're full of crabs. I gotta say it like that. I don't want to really do it like that, but I gotta say it like that. This is why. I want to be careful with it. The world pretends to want to help, which there are people that do. But I found that, let me say it again. But I found that I can't eat this. Smack it. But anyway, I found that people, this is from me, you guys, seriously, I'm not joking. I found that a lot of people that are selling information out here, they don't care. They do not care. What I mean by that? They're not really giving y'all anything. Well, I'm not giving you nothing. Not no practical how to let me get on my boots on the ground right now and get running on. If it is somewhere it's in the book that you don't have, or you probably haven't read it, you do that. That might be the one people skill on. I'm gonna give some resources at the end of this, but it's just, I've noticed that over the years that people don't really give you the information. They're gonna give you a piece of it, and they're gonna leave you. Before you know it, you just sat there and did all that work, took all them notes. You sat there that whole time, and you didn't get nothing. You still don't know what to do. You still don't know what's next. And that's a problem. I think it is. I think it's a problem. Because people need help. And it's unfortunate that so many people are just looking to pivot themselves in positions where they just gonna take. They ain't gonna give y'all. This idea of mine came from a doctor. You can look him up. His name is Dr. Brenda. The reason, what idea is that he gave everything away that he knew, that he built for free. He had a free app, I should make it. A free app where you give you free information. It's a plethora. And he does sell a book. It's cheap. It's a big old book. And he was the one that made me see that there is somebody that cares about people. So his is health, mine is financial. Opportunity. Scenarios leading to fix. That's it. When I was growing up, I obtained a gift from my parents. And my parents were titled amongst a group of people of their peers. The Means and Ways Committee. And I'm the product of those two. The Means and Ways Committee. Now you have What's the Move with Nathan Scott. Real decisions, real scenarios, real decisions. So I want to say to you guys that this is why I want, because I know there's a lot of people that's going to give you a bunch of fluff, a bunch of hype, a bunch of feel good stuff, have you doing a bunch of nonsense, and it's nothing that's practical. Starting your journey to wherever you want to go, wherever it is. And you want to go somewhere, and you're trying to get there for real. For real. If you're getting on here, you need it. Something happened. Something is in the way. You need this. You need it. So let's get to it. So what this is instead of building a business from scratch, you buy one that has already generated profit. Not any profit, but a significant profit. And the existing system, customers, and cash flow transfers to you. Now, you can either operate it or hire a manager to operate it. I would operate it maybe for about a year to make sure everything ran right. If I knew how to operate it. Not, I would get it. And someone that's qualified. You can find it. Just got paying. Now, why is this the salesperson's ultimate move? I believe it's the ultimate move for your cousin, whoever your cousin is, your cousin to understand that he understands sales, he or she understands sales, they understand customer relations, and they understand business operations. These are exactly the skills needed to evaluate and run a profitable small business. Now, the difference is instead of being the salesperson this time in the business, they have become the owner of the business. So what should they buy? Well, you have many businesses you can buy, but let's go over a few. You got your B2B business services, B2B service businesses. Right? They usually consist of cleaning companies. Cleaning companies can be house cleaning, carpet cleaning, boat cleaning, car cleaning, you name it. Cleaning companies, landscape companies, bookkeeping firms, or marketing agencies. These are usually your B2B businesses. You also, now, B2B business. Another one they can buy are e-commerce businesses. E-commerce business with established customer base. For example, where e-commerce brands with established customer base. Okay, so what else can they buy? They can buy laundromats, car washing service. Well, no, you got laundromats, you got car washing service, then you got car washing locations. You got vending machine routes, and you also have franchises. They also can buy franchises with existing location and existing cash flow. Where do you find them? The best places I would look to find them are bizbuysales.com. It's BIZBUYSELL.com. The largest marketplace for small business acquisitions. You also have Flippa.com, which is an online business. It's online businesses, SaaS, SaaS, and e-commerce. So these are where you get those type of businesses. Also, you have microacquire.com. Microacquire.com is a tech and online business. Then it's for tech and online business. Also, you have local business brokers. They know businesses for sale, and they know them before they're listed publicly. So here's the math that makes it work. A business generates $100,000 in sales, discretionary earnings, and that's also what we know as SDEs. Might sell for about 2.5 to 3.5 times multiplied equals about 350,000 purchase price. So, another way to get a business is through the SBA loan. Can finance about 80 to 90% of purchases, meaning about 70,000 down payment. Now, after debt services, the business might still need to generate 60,000 in annual cash flow. That's $100 to $200% plus annual turn on the down payment. Why this path is the powerful path, or for me, the most powerful path for the salesperson. And this is because they can step into an immediate step in and immediately improve the business. And businesses, if they're good at business, also, which is the most part of business, is sales process, which is often in other businesses the weak point. A business doing well operationally, but poorly at sales, is perfect target for a sales professional. They can increase revenue without increasing cost proportionally or dramatically by boosting profits. All right. So I run out of time here. Now. Okay. We got it. We heard the round. We heard the first round. All right. So we went on path A, path B, path C, path D. Now we're on to our last path. Please, guys, take notes. Get this. This is for, and I want to say this. This is not just for anybody in sales. This is for anybody who just want to have their money working for. You're in any type of career. You make some good money. You might want this. Why? Because this is gonna make it where you have your money working for you, passive, and if you do it right, you have it working for you passive and aggressive at the same time. This is beautiful. All right, path E. We're moving on to path B. We're moving right along, people. Once again, everybody who's joining us, this scenario is my cousin wants his money. Making money. Yeah, that's pretty much it. That sums it up, guys. Trust me. All right. My cousin wants his money making money. That's a scenario, and we're solving it. We're currently on path E. And path E is the royalties and alternative income stream. That's right. Royalties and alternative income streams. And what is it? It is buying existing income streams or streams to royalties from music, books, patents, mineral rights, or digital products. You pay a lump sum up front and receive ongoing payments. Here are the platforms. I'm giving you guys juice today, I'm telling you, because this is what I use. I don't even know if I'm going to give it to you. I promise I will. Promise I was going to give you guys value. This is it. The platforms to work with. 1. Royalty exchange. Now, what is royalty exchange, you may ask? Royalty exchange buys, you can buy royalties from music, films, and entertainment. You can. It is a site where people catalogs. You can lease them. You can buy them. You can own them. And they let you know how much the catalog is worth, how much it generates monthly. Easy, good, fast, clean way if you got some capital. About 20, 30,000, maybe 40,000, 50 capital. Right? You can buy people's catalogs that have been movies, no film. Also, you got A-Note music. You can buy, like I said, music royalty shares on A-Note music. That's A capital A music. One word, A-Note, excuse me. A-Note space music. A-Note is one word. And that's A-N-O-T-E music. You can buy music royalties and shares. You also got Songvest. Songvest is a music royalty auctions. Also, you got Flipper and Acquire. Once again, .com. You can buy with Flipper and Acquire.com. You can buy digital products that generate ongoing revenue. Examples. I love doing my examples. I love doing these examples because this one I kill me. You buy a music royalty stream generating $5,000 per year for a purchase of about $40,000. 8 to 10, 12, or 8 to 12 times multiplied, similar to real estate cap rates. You now own a piece of an artist's catalog. Every time their song streams, you get paid. Can't tell me that's not a deal. You can't tell me that's not money. How? Now, number 6. So how do I start? How to start with whatever capital is available. Starting capital best path expected annual income. Bear with me, guys. Okay, I'm moving too fast. Okay. So, let's start that back. Scratch what? No, you don't scratch what I said, but I think I'm done with my paths. Yeah, that was all my paths. Okay. I'm about to go to something new. Not something new, but something important. And this is what we do with our capital. So, hope everybody's still with me. We're about to go an hour strong soon. It's been a pretty fast show so far, and the show is almost a wrap. So, let's go over it. How to start with whatever capital is available. Now, starting capital best path expected. Annual incomes of 10,000 dividend ETFs plus REITs at 800 RTIT 800. That's like 25.000 REITs plus private lending platforms 2,500, and that's 5,000 of all of the. Excuse me. Yeah, REITs 800 and 25,000. Yeah, 25,000. Yeah, and 50,000 all above plus ground floor to Fundrise plus first note deal at 5,000 plus 100,000 all above plus direct private lending plus down payments on small business $12,000 and 250,000 all above, plus SBA loan, business acquisition, plus private equity syndications at 40,000. That's $250,000 plus full diversification across all asset classes at 75,000 plus. Okay. I'll go over that again for you guys. It's not a problem. Bear with me. Bear with me. Let's go over that again. Like I said, so that's 10,000. At 10,000K, focus start, build the foundation. Revenue allocations are 60% in index fund, 30% in dividend ETFs, and 10% in high yield cash. Expected annual income would be $800 to $1,200. Example moves: open a broker account. One. Open a broker account. One. Buy broker market. Buy broader market ETF. And start dividend portfolio. The next level is 25K. Focus is add income layers. Recommended allocation is 40% to index funds, 30% to dividends, the REITs, ETFs, and 20% to private lending, and 10% cash reserve. Now, expected annual income here is about $2,000 to $3,000. Example moves is we add REITs for real estate, invest in private lending, and keep building monthly. At $50,000, focus diversify. The focus is diversify and scale. And the recommended allocation for this is 30% to index funding, 25% to dividend REITs, I think about 10% to cash reserve, and 10% for opportunities. Right here, the expected annual income should be about $5,000 to $6,000. The example moves are first direct note deals, explore some business acquisitions, and increase income stream. The next one is 100K. The focus is leverage. And what I mean leverage is leverage capital, and increase income. Recommended allocation is 25% for index funds, 20% to dividends or ETFs, 25% to private lenders, 15% to cash reserve, and 15% for business and others. Now, with that, your expected annual income for that is about $12,000 to $15,000 a year. The example moves in this area is like down payment on property, SBA loans on business, and building lending portfolio. The next one is $250,000 or $250K. This focus is more accelerated and optimized. The recommended allocation for recommended allocation is 25% index funds, 20% dividends, REITs, ETFs, 25% in private lending, 15% for cash reserve, and I said that wrong. That's 20% for index funds, 20% for dividends or REITs, ETFs, 20% for private lending, 20% for business ownership, and 20% for alternatives. The next one is 250K plus, and that is focused on wealth freedom. Wealth freedom is when you get to that about invested build legacy wealth and live on your terms. And recommended allocation is about 15% for index funds, 15% to dividends or REIT ETFs, 20% to private lenders, 25% now to business owners, and 25% to alternative. Expected annual income here from investments will be $75,000 plus. And that example moves is from multiple income streams, hiring managers, and focus on freedom. That's right. That's right. We are focusing on freedom. Hope you like that one. Hope you like that one. All right. Let's not do that. So we're moving on. So we're running out of time and we're moving on. The next one is the strategy sequence. And this is from salesperson to owner. We getting there, people. From salesperson to owner. Yeah. Isn't that a beautiful thing? Isn't that a beautiful thing? Let's start pulling for you guys. So, the strategy sequence from salesperson to owner. Phase 1. Build the foundation, and that should take from 0 to 6 months. Get started on your foundation today if you can. Open, like I said, open a brokerage account, and that can be with Fidelity, Schwab, Vanguard, etc. Third, deploy existing cash into a mix of 50% of broader market index funds, VTIs or VOOs, for long-term growth. Next, 30% dividend or income ETFs. For example, that'd be SCHD, and that'd also be JEPI and VNQ for current income, and that's at 20% in high yield cash, and that's like money market fund earnings, about 4 to 5% for a future opportunity. Now, this immediately starts the making money engine going while preserving capital for bigger moves. Phase 2, add income layers. This will happen between 6 to 18 months. What I want you to do is research and invest in private lending platforms, ground floor, and Fundrise. Those are your two. Don't worry about nobody else. If interested in real estate, begin attending local meetups. Get to your first local meetup. Look it up. Get there. Don't ask a question. Just go. And build relationships with active investors. Next thing I want you to do is explore businesses or business acquisitions by browsing Biz Buy Sales, Biz, BIZBUYSELL.com, and Flippa, FLIPPA, to understand what's available at your price point. Next, continue adding to dividend portfolios monthly. Phase 3, making a big move here. This is within the once you get to your 18 to 36 months. Do not let it go past 36, please. With more capital accumulated and knowledge, gained, execute a larger acquisition. Buy a cash flowing business using SBA financing. Acquire a direct private lending portfolio. Purchase a rental property with 25% down. The income from this big move will begin to supplement and replace active income. Phase 4. This happens within 3 years to 7 years. Compound and scale. Compound and scale. Use income from assets to acquire more assets. Let me say it again. Use income from assets to acquire more assets. Hire management for any active businesses or properties, and gradually transition from operator to pure owner. Got it? Do you 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 have it, seriously? Because now we're about to do this psychology shit. Alright? Yeah, this show is moving along. I'm gonna get done before before an hour and 30 minutes. Good luck. Right. Number 8 is the psychological shift. From earner to owner, this is the hardest part. Someone who has spent a career in sales is wired to think more effort equals more money. The transition to owner requires embracing delayed gratification. A dividend portfolio generates modest income today, but compounds into significant income over 10 to 12 years. It does. It does. And evaluating the risk differently. Owning assets feel riskier than earning a commission because you see the fluctuation. But long-term, diversified assets have historically preserved and grown wealth better than cash. Think in a system. The goal is to build a machine of assets that generates income, regardless of your daily activity. This requires upfront effort, research, allocation, acquisition, but then minimum ongoing work, patience with scale. Patience with scale. The first 100,000 of income producing assets is the hardest. The second 100,000 comes much faster. The first 100,000 is the hardest, the second is the fastest. The third, faster still. The compounding curve rewards persistence. So what is our pros and cons? That's where we want to go. Pros and cons. What are the pros and cons? I mean, y'all like, what in the world are you doing? Just say them already. Okay. The pros and cons. Let's go. Pros and cons. Realistic timeline to meaningful income is what we're about to go over. Meaning income, dividend, ETFs, instant diversification, completely passive, and liquid modest yields are subject to market fluctuation and immediate small income. 5 to 10 years for significant income. I'm telling you, you got to be in for the haul. 5 to 10 years for significant income. In REITs, real estate exposure without management. Monthly income tax as ordinary income, not qualified dividends. Immediate small incomes, right, compounds over time. Private lending is high yield secured by property, short-term illiquidity. Default risks are some of the risks, but it does require due diligence. 30 to 90 days to first payment. For business acquisition, highest potential return. Leverageable with SBA loans. Requires operations and management. Concentrated risks are 3. I don't know what that is. Required operation risks and concentrated risks are 3 to 12 months to stabilize and extract income. All right. Royalties are truly passive, uncorrelated to stock market, hard to value or accurately, but they're hard to value accurately. Niche markets are 30 to 60 days to first payment. All right. Now, okay. Now, common points of failure. And common points of failures are chasing yields blindly. Let me go there because I have no spot for that. But I call it the yield trap. The yield trap. And the yield trap is chasing yields blindly. At 12%, yields that erode principal is worse than a 4% yield that grows. High yields often signal high risk, not diversified. Putting everything into one asset class, one business, or one loan. When it fails, everything fails. Don't do it. Also, underestimating taxes. Investment income is taxed differently than earned income. Qualified dividends get preferential rates. REIT dividends are often taxed as ordinary income. And I'll double check that to be sure. And private lending interest is ordinary income. Plan accordingly, and also do your due diligence on that. If I have any corrections on that, because I think some changes have been made as of 2023 or 2024. But anyway, nonetheless. And the next one is impatience. Impatience is Expecting about $50,000 portfolio to replace a $100,000 income a year. That's impatience for sure. Not only that, in a year or in year one, like, come on, that's not realistic. Asset income builds slowly at first, then it accelerates. So just know that. Another one is maintaining the salesperson identity. The cousin has spent years as the guy who sells. Transitioning to an owner means something, or sometimes doing less, and that can feel, or not, doing less and not more. So that can feel uncomfortable for salespeople. All right. So I want you to stop thinking of retirement as the goal. Think of finance independence, the point where asset income cover basic expenses. Yeah. And that's the exit ramp. That's the exit ramp, people. The exit ramp from chasing sales. Better structure. Hold income producing assets inside tax advantage accounts. Roth IRAs, traditional IRAs, when possible, to avoid or defer taxes on the income. Better integration. Use the sales income to systematically feed the asset engine. Every commission check, a percent goes to buying more income producing assets. This builds the habit of converting labor income into capital income. Don't try to fully replace earned income overnight. Not smart. A lot of people won't tell you they can do that. Be careful. Be very careful. Aim to replace 10% of income with asset income in year one, 20% in year two, and so on. The gradual transition is psychologically sustainable. Now I'm about to go over some references. I want you guys to take these. Here's your references. Principles. The first book I want to reference is one of my favorites, The Simple Path to Wealth by J.L. Collins. This book is the foundational guide to stock market investing for income and growth. The next book I would like to recommend is Buy, Then Build by Walker Deibel. That's D-E-I, excuse me, D-E-I-B-E-L, Walker, D-E-I-B-E-L. The definitive, and this is the definitive guide to acquiring an existing business rather than starting from scratch. All right, so compound money, making money works because income reinvested generates its own income. Over time, the curve bends upward exponentially. In real-world examples, many successful small business owners in America build wealth not by earning high salaries, but by buying modest cash-flowing businesses, operating them in the discipline, and using the profits to acquire them. The crossover point is the moment when investments income equals or exceeds living expenses. At that point, the cousin can never The cousin never has to chase another sales unless they want to. And that's the facts. That, my friend, is the fact. Yeah. That is the fact, my friend. Bear with me. All right. All right. Yes. That's the beauty, my friends. So, yeah. We could have a show that goes a little more deeper into it. I will let you guys know. Until now, yeah. So, today, people, we open once again a dangerous door tonight. And we didn't even, I promise you, I know, we did not even get into the deeper side of it yet. I'm Nathan Scott, and this is What's the Move?
Move with Nathan Scott. Want your situation featured on What's the Move? Well, send your scenario to whatsthemove@nate@gmail.com. Until next time, be safe. Thanks for joining What's the Move with Nate.